Good morning and welcome to the Drilling and Production Outlook. I'm Richard Spears and this is my brother,
John Spears, yes.
John, I was doing some math earlier.
Okay.
And I realized that you know how old you were when you first started doing the DPO?
How old I was?
Yeah.
Yeah, I got an idea that's how old I was, yes.
Hey, you want to tell the customers?
28, 29, something like that.
27.
Oh boy, there you go.
I don't know, maybe my math is a little off, but because you're 66 now, and again, that's 39 years.
There you go.
One more year, 40 years.
Boy.
You got 10 more and we can make it an even 50.
Gold watch, yeah.
So we're going to keep doing this until John gets it right. But if you've been a client of the DPO, you know that this is very simple. You will John is going to lead us through the discussion of the high level parts of the forecast that has come out now, and during the presentation, if you have a question, there's a chat box on this YouTube channel, and you can just type in the question, and I'll be monitoring it because I'll leave the screen.
Sure.
You'll be making the presentation. Send in the questions, or if you've got my email or John's email, or Katie's email, send those in, and we'll gather the questions up. And at the end of the presentation, I'll come back in, I'll read the questions, we'll answer them.
We got a little time for that.
You're going to try to do this entire presentation pretty quick, right?
I want to wrap it all up in an hour if we can.
So here it is, whatever the time is right now, 8 o'clock. We'll try to be done with the formal part at 9 and go on. So anyway, thank you very much for being a client. If you are not a client but you're watching the video part of this, glad to have you. You can subscribe to this drilling forecast by going to spearsresearch.com. You'll find the Drilling and Production Outlook link, and you can sign up and get all of the written and tabular and consulting related background that we have provided to our clients for almost 4 decades.
There you go. Sounds
So
good.
thank you very much. I'll turn it over to my brother now.
Well, thanks, Rich, and thanks for joining us this morning as we review the upstream oil and gas industry and talk about the outlook for the next year from a drilling and completion standpoint. We always start with the fundamentals, and this time will be no different. I think we can move through it pretty quickly, though, because as it turns out, the story regarding global oil demand and supply is one that hasn't changed very much since we were together back in June. The global economies continue to open up. Economic activity continues to rise. Of course, it's fits and starts because, as we all are aware, the Delta variant of the COVID virus has caused problems, and so that means that the outlook surrounding demand, anyway, is a little bit more uncertain than it might otherwise be, because not quite sure what steps might be taken or might need to be taken in terms of protecting health and so forth, in terms of lockdowns and so forth. But broadly speaking, things do continue to open up and are expected to continue to open up. And in fact, as you can see on the chart here, demand, which is in the blue line, continues to move on up and to the right. And in fact, by the end of 2022, will be higher than what it was pre-pandemic in the fourth quarter of 2019. So demand is growing and is expected to increase to an average of about 101, a little over 101 million barrels a day in 2022, up about 4%. The more important story, or the story that's inside the global oil market, is that it's moving from a period of shortfall this year, or undersupply this year, to a period of oversupply, slight oversupply next year. And you can see that, again, looking at the chart, the red line, the supply line, has been well below demand all throughout 2021. But as we look forward into 2022, the supply will be slightly higher than, or is projected to be slightly higher than demand will be. So the market's moving from shortfall to surplus. That means a couple of different things, I think. One is that, broadly speaking, there shouldn't be much pressure or as much pressure on oil prices to move higher. And that Keller's our estimate of where we think oil prices will be next year, simply because it looks like the market's going to be pretty well supplied. And again, all this reflects the decisions by OPEC Plus, which has been meeting this week, and reaffirmed its decision that it took back in July, as I recall correctly, where it plans to add 400,000 barrels a day per month to the market starting in August and extending through the end of this year. And then beyond that point, its intent is to continue to add and meet the rise in demand. And the group hopes that by the end of 2022 that its output will be fully restored to what it was prior to the pandemic, 2019. So the market looks like it's going to be pretty well supplied. And that, I think, and inventories will probably begin to bump up a little bit. They've been shrinking this year, but going forward, it looks like inventories are beginning to stabilize and then probably expand. And all that tells us that oil prices will probably not be pushed higher, and in fact might be expected to trend a little bit either flat or down over the coming 6 quarters. And so our estimate is that oil prices, spot WTI prices anyway, will average $68 a barrel next year. That's up about $2.50 from where it's going to average this year, but as you can see, it's down a little bit from the $70 price that we were at in the early days of the third quarter. Brent prices are, I think, going to trend about $3 above where WTI is. So for those who are looking at international markets that really use the Brent price as the marker, that's where we think Brent is headed. It's interesting to note that even though OPEC expects that its production will be fully restored, that its 2019 level of production will be fully restored by the end of next year, it will still have something over 4 million barrels a day of spare production capacity at that time. So as you begin to think a little bit longer term, 2023, 2024, it appears that there'll be sufficient supply around to meet any expected demand growth that might take place. And so I think the oil market's finding itself at a point where prices will continue to bounce around, but not materially move much higher, perhaps not much lower over the next 2 to 3 years. So, but a $68 price is what we think will be in store for 2022. What does this mean for here in the U.S.? Well, crude production has been gradually rising. The blue bars on the chart, at least for 2021, have been increasing since the first quarter of this year. That was when, of course, Texas had the mighty freeze and had its impact on Texas production. But that's been restored, and since then output has been gradually creeping higher. We think that next year, based on the numbers that we expect to see turned in from the drilling and on the completion side in 2022, that U.S. oil production will end up averaging somewhere close to 11.7 million barrels a day. That's up about 5% than the average that we expect to see this year. But even at that, 11.7 million barrels a day will still be about 1 million barrels a day, in fact a little bit more than 1 million barrels a day shy of the high point back in the very earliest days of 2020. So we're as an industry anyway, we're gradually recovering the production levels, but it's not a quick growth. I think it's much more slow given the discipline that we see operators continuing to exercise around their capital spending budgets. And of course, I think the story then for gas production anyway here in the U.S. is much the same. Production gradually recovering, gradually rising. Again, it also took a hit back in the early days of 2020 when we turned off the drilling function and stopped adding very many new wells, and so output fell pretty sharply and has only gradually begun to recover. By the end of next year, it would appear to us that gas production here in the U.S. will be slightly higher than what it was back pre-pandemic levels. So, but it's a slow growth in terms of how the recovery is going. And again, most of the improvement in gas production is really thanks to the recovery in oil production, all that associated gas that comes from those oil wells we're completing in the Permian Basin and elsewhere is really adding to the market, and that what accounts for most of the incremental growth in gas production going forward. If we look at gas production from dry gas basins like the Marcellus or Haynesville, output there, while it is rising, is not the major factor in contributing to this growth that we see here on the gas production side in the U.S. And if gas production is growing, then again, it reflects what we think will be a fairly well-supplied market next year. So our Henry Hub spot price for 2022 is an average of $3.50 per million BTUs, and that happens to be where we think spot gas prices will end up averaging in 2021. So no growth year over year in terms of average spot gas prices. It is interesting to think of some of the fundamentals underlying the gas market here in the U.S. Gas demand, or rather I should say gas consumption, the use of gas in homes, commercial buildings, industry, and power, all that we would think will be up somewhere between 1% and 2% next year, so a bit of an increase. Almost all of the increase is actually accounted for by industry and by the power sector. Not much growth in terms of homes and business. But the real story, as it has been for quite some time in the U.S., is how fast gas exports are growing. And after about a 20% growth this year, gas exports are forecast to rise about 5% next year. So at least in terms of overall demand, there's going to be fairly healthy expansion there. And so an increase in production, I think, will go a long way toward satisfying that demand without requiring gas prices to move any higher. And so we're looking at a fairly flat year over year gas price, although as you can see from this chart and from experience, we know that the quarter to quarter swings can be pretty dramatic as we move through the year. So that part of the story hasn't gone away. The final piece of the fundamental side of the story on gas is, of course, around inventories. One of the reasons that gas prices averaged in the U.S. last year right at $2 per million BTUs, and this year they're $3.50 a million BTU. Why is that? Well, we have dramatically shrunk inventories. Working gas inventories have fallen by almost 17%, stand about 17% lower right now than what they were a year ago at this time. And the projections are that once we get into the winter months, that gas inventories of around 3,400 billion cubic feet will be, again, well below what they were last year, the lowest, in fact, since 2018. And if I remember correctly from the charts I was looking at, it'll be the second lowest number going back as far as 2007. So the market's set up the gas market in the U.S. is set up to be fairly tight next year. We don't think it's going to grow materially tighter than what we see it now. Again, a part of that is because gas production will be on the increase, but that should keep prices around where they have been this year in the U.S. So around a $3.50 handle on gas prices is what we expect for 2022. Now, the other part of the story, as we begin to think about drilling and completion markets here in the U.S., is, of course, not just what's happening on prices, but now we have to take into account the discipline, the capital spending discipline that operators are beginning to exhibit, because in the old days we could pretty much directly translate price increases to changes in rig activity if we were to lag those two data series by 3 to 6 months. But now, of course, there's this decision in between, which is great, revenues are rising because prices are going up. Am I going to spend that money on increasing production or stabilizing production? And oftentimes we're finding these days, of course, is that operators have better uses for their capital. They're, rather than using it to drill new wells, they're returning it to shareholders and to debt holders and the like. And this chart's informative of that. So we look at the quarter by quarter reinvestment ratio, which is capital spending divided by cash flow from operations. And what you see, of course, is that this year that reinvestment ratio has fallen to really all-time lows in the second quarter of 2021. The reinvestment rate was just at 40%, and back in 18-19, and for the full year of 2020, it was in the 85% range. Going forward, we think that we've seen operators begin to tick up their activity, and so we think that will contribute to a somewhat higher reinvestment ratio. The data that we're looking at on this chart comes from a database that we've pulled together. It has about 30 publicly traded companies headquartered here in the U.S. Most of their operations are here in the U.S. And so we've gathered the revenues, the cash flow from operations, the capital spending, and so forth of these companies to track what's going on with regard to their the use of their capital, since the story we certainly for the past year, and we think going forward, will be that any drilling and completion activity will basically have to be self-financed. They'll have to come out of internally generated cash flow. And those cash flow dollars, then the drilling budgets and the completion budgets will have to compete with returning capital to shareholders and returning capital to debt holders. And so this is part of the story looking at the reinvestment ratio. These ratio numbers translate into capital spending figures. And here's what we see again from this group of companies that we're following, which account for about about 40% of the rigs here in the U.S., but about 55 to 60% of the CapEx in the U.S. So it's a good, healthy chunk of the U.S. upstream story contained in these roughly 30 companies. I always have to say roughly because these firms have been very active in recent months and continue to be active in terms of acquiring properties, acquiring other companies, and so the list tends to see firms added to it as public companies by privately held firms, although there are some public-to-public mergers that take place as well. So all this is going on, but it tells us that the capital spending in aggregate is beginning to rise, has begun to rise. Probably add up to somewhere around $48 billion next year from this group of companies. That's up about a third from where they will end up being this year in total. So again, the drivers are increased activity. There's also a certain amount of well cost inflation, we think, which will eat up some of these dollars. We'll talk about that in a little bit. But generally speaking, most of these companies have stated that their intention is to basically hold production at its current level. So they're not really chasing a higher growth in output, not like they used to. What they're saying is we're going to spend the capital needed to hold production. Maybe there'll be some selective growth in it, but it won't be the days of chasing barrels like it used to be back in 17, 18, and 19. So what are they doing to the extent that they're returning capital to debt holders? That's a fascinating story, and that's shown on this particular chart. So as you can look back to previous years, 17 and 18, this group of companies was retiring debt to the tune of about $2 billion per quarter those years. In 2019, it was taking on debt to the tune of about $4 billion a quarter. Last year was kind of a break-even number. A lot of debt was issued, but a lot of that debt that was issued was used to retire higher cost debt. So there was really pretty much just no net change in debt outstanding in 2020. But the first two quarters of this year have told a different story. First quarter, this group of companies retired about $4 billion worth of debt. Second quarter was over $6 billion. We're projecting that it'll end up averaging somewhere between $4 and $5 billion per quarter going forward. So in all, again, $20 billion worth of debt being retired in 2021 and $16 billion being retired in 2022. So what's interesting is what that means to the overall leverage of these companies. And as best we can tell, all these firms as a group had a collective leverage figure of around 45% in 2020. Well, if these debt retirement numbers are in fact do come true, and you look at the profitability of the firms, it looks like leverage is going to fall from around 45% to around 30% come 2022. Beyond that point, I really question whether or not the industry as a whole, or certainly a group of 30 companies like we're following here, will be in aggregate be net retiring of debt come 2023 and beyond. So this story about retiring debt is certainly valid today, and I think will be valid in 2022. But beyond that point, I think the industry may go back to a more neutral standpoint, probably not taking on debt, may not be allowed to take on much debt, trying to find someone who's willing to lend them the money. But I think that what that tells me is that there'll be somewhere in the order of $15 or $16 billion that is being used to retire debt in 22 that might now become available to spend on some other activity. It might be drilling, it might be acquiring other companies in the years after 2022. So it'd be interesting to keep an eye on this. Certainly these companies as a whole are following through on their commitments to delever, and so that's a function then of how much capital is available to go into drilling and completion. The other part of the story that sets up our expectation for the market next year is what's been going on with regard to the inventory of drilled but uncompleted wells, the famous DUC count that the industry has followed and discussed for quite some time. So this chart looks at the number of these drilled but uncompleted wells as reported by the U.S. Energy Information Agency in its drilling productivity report. Those numbers come to us through about the middle part of this year, and so anything after Q2 21 are our own forecasts of where those numbers will settle. But it's our conclusion when we talk to operators, when we think about the nature of drilling and completion activity as it exists today, which means that 85-90% of the wells we're drilling are horizontal wells. Most of them are being drilled on multi-well pads. 3-4 well pads is the most typical size for a multi-well pad. It takes about 2 months from start to finish to drill the 4 wells on that multi-well pad, and only after the last of those wells is completed can frack activity begin. And in fact, most of the time another couple of months will pass before the frack crew shows up. And so easily 4 months, oftentimes maybe a bit longer than that, 5 months, will have passed from the time the first rig shows up to the frack jobs take place. And so what we are seeing then is about 4 months worth of, 5 months worth of drilling activity that really goes into this uncompleted category. Think of it as work in process if you come from a manufacturing background. And so by our lights, as we look at rig productivity and so forth, we're estimating that about as far down as the DUC count can go is around 5,000 wells. At that point, you're sort of to the irreducible minimum, given the fact that there's 500 or 550 rigs running in the U.S. So clearly the number of drilled but uncompleted wells is a function of how many rigs are running. And again, so we think about today there's a little over 500 rigs running by Baker Hughes count. By the end of this year, there'll be closer to 550 rigs running. So at that point, we think about 5,000 wells represents about as far down as the DUC count can go. So what does that tell us? That tells us that if operators intend to hold production flat, they need to, what that really means is they need to hold frack activity and completion activity flat from 2022 to 2023. Well, this year, a lot of the completion work that's gone on, about a third of it, is probably come from the form of these uncompleted wells that were drilled in quarters or years past that are now being fracked and brought online. And again, we can't continue on. That's sort of a one-off event that stretches from roughly midpoint of 2020 to the end of 2021. And then beyond that point, if frack and completing activity is to stay steady, then the industry will need to drill a lot more wells than it's drilling today, in order to hold completion and production levels fairly steady. So this has guided our estimate of where we think rig count and so forth is going here in the U.S. this year. From a rig standpoint, the chart looks like this. We're at a roughly 500 rigs today. We think we'll be close to 550 by the end of the year, an average of around 470 active rigs in 2021. So the year-to-year numbers are up about 9% this year. We think next year rig count will average just a touch over 600 rigs, and that would represent about a 28% increase in rig count year over year, 2021 to 2022. What's interesting is that so far this year, privately held firms have been adding rigs at about 3 times the rate of those publicly traded firms that I was talking about earlier, that we were showing their financial performance. I think the fact that the privately held companies have been adding rigs so much faster probably reflects the fact that their activity fell so much during 2020. So they fell harder, and that has contributed to why they've been coming back faster so far this year. But I think going forward, it's not like these privately held firms are not being capital discipline exemplars of capital discipline. I think they're just when you go from 0 rigs to 1 rig or 1 rig to 2 rigs, the percentage growth looks pretty tremendous, and that I think is part of the story that we've seen happen this year. Going forward, I think the rate of growth will probably normalize or look pretty much the same between publics and privates in our sample and here in the U.S. One of the things we've done different and now add to our quarterly report is an estimate of how many wells are being spudded here in the U.S. So we've talked about rigs being active, but what does that mean in terms of wells being spudded? So we're now trying to come up with those numbers quarter by quarter, so that those clients who are more tied to the drilling process and perhaps more meaningful, it's the way to count wells spuds as opposed to active rigs. We want to have those numbers in place as well. So as it turns out next year, we think that there'll be around a little over 15,000 wells spudded in the U.S. Again, up about 28-30% from what it has been in 2021. So it's not at all surprising that well spuds and rig activity move in lockstep. One of the things we found over the last several years is that when we measure drilling activity in terms of well spuds per active rig, the number's been pretty constant. It's very close to 25 well spuds per rig per year. And that figure hasn't changed very much. Rig activity or rig productivity has grown because the length of a well has increased. But if you look at it just in terms of numbers of wells per rig, that's been pretty constant. And so that's one of the reasons why our numbers for rig activity and well spuds move very close together. We've talked about well spuds. Now we want to talk about frack jobs. So frack activity, again, has grown very sharply this year. In fact, if we look at the count of frack jobs, it's grown over 30% this in 2021. But again, a big part of that has been because of the retirement or the reduction in drilled but uncompleted wells. And if that story will in fact be done with next year, then 2022 frack activity will have to reflect what's going on with regard to well spuds. And so that adjustment process we think will be taking place perhaps in the latter days, beginning in the latter days of this year and stretching for the first 6 months or so of 2022. And that's one of the reasons why the bars on this chart have a little dip in them after the end of 2021. But the point being that frack activity, at least measured in terms of job count, won't be changing that much. We think it'll be up on the order of about 3% next year. Again, there won't be that many ducks to take offline, so it's all a function of how many well spuds are out there. And so off we go with that count. Final thing we look at is the number that the American Petroleum Institute has long reported, which are well completions. And this is different from frack activity or well spuds, because well completions to the API means how many new oil and gas wells are being put into production, plus how many dry holes were drilled. So this is the well completions number that the API reports. And so completions occurs at the very end of the process. First we have spuds, then there'll be frack activity for most wells. Not every well gets fracked, but many wells do these days. About 85% of the wells get a frack job on them. So first the spud, then the frack job, finally the completion. And so again, each will have its own sort of pattern as the year or years unfold. And so by our lights anyway, we estimate that API will end up reporting around 15,000 well completions next year. The number for this year I think is on track to end up around, if I remember correctly, around 14,500 to 14,600 well completions in 2021. So however you want to slice the data now, we have several different options for folks. We have rigs, we have well spuds, we have frack activity, and we have well completions, all here in the U.S. We do a quarterly survey. We talked about that before, looking at the cost of wells, and our most recent data point is for the second quarter of 2021, which, as you can see from the chart, saw in aggregate a little over a 3% sequential increase in quarterly well costs. So this was a 3.3% increase from the Q1 numbers, right? So again, not surprising that well costs fell dramatically throughout 2020 as rig activity collapsed. But as rig activity has begun to increase, we've seen these well costs, so drilling costs, completion costs, begin to rise. A big part of the rise, at least in the first half of the year, has been the sharp increase in casing and tubing prices. And of course, that's linked to the increase that every industry has seen for steel costs. So in that second quarter increase, 37% of that quarter's increase was due to higher pipe costs. Almost 20% was due to higher rig costs, much of which was associated with higher fuel costs. And finally, there was about a 15% gain in the cost of stimulation services. So we hadn't seen stimulation pricing recover at all for several quarters. It's begun to show its head in the second quarter of this year. As best we can tell, we think this quarter-to-quarter sequential changes will end up averaging somewhere in the 1% to 2% range going forward. But it's a hard thing to follow. One of the things we have noticed is that for the first 6 months of 2021, none of the price increases has really been linked to higher labor costs. So it's been things, fuel, pipe, and so forth, but really not higher labor costs. And from what we're hearing in the field, labor shortages have emerged. Suppliers are saying we need to pay more in order to attract more people. And so I wouldn't be surprised if going forward we don't see the labor rates for various services associated with drilling and completing wells begin to go up. And so that probably will be a more important driver of well costs and price increases going forward than it has been in the recent past. Switching out of the U.S., we want to talk about Canada for a little bit. Canada's had a great recovery here in the second half of the year. Rig count has been a factor of for some weeks and months 4 and 5 times higher than what it stood in the third quarter of last year. So it's setting up very nicely for a near 30% increase in rig activity this year. And in 2022, we're calling for rig count in Canada to rise 28%, 171 rigs, 171 active average rigs, a little over 6,500 new wells drilled, and around 58 million feet of hole. They're having an election up there, which will be decided within the next couple of weeks, if I remember correctly. It's the polls would suggest that it's a tight call at this point between the current Liberal Party and the Conservative, their main opposition, the Conservatives. So who comes out on top is unknown at this point. I don't know that it will have a lot of effect in terms of support for the industry. Both parties have tended to be pretty supportive, particularly for energy exports. So working to get pipelines built or smoothing out the permitting process for LNG, so forth. There is a difference between the parties in terms of what each would do with regard to carbon pricing and border adjustment taxes and things like that. So I don't know that that affects the industry up there directly, but anyway, it's something to keep an eye on just in general, because clearly the price of carbon will influence and direct investments regarding fossil fuels. We have a section in our report that I would refer you to where we're now trying to pick up what's going on with regard to carbon pricing in various places around the world. So for example, we are looking at the European Emissions Trading Systems, ETS price, which is currently, if I remember correctly, just touched 60 euros per ton, metric ton of carbon dioxide. So that would be almost a $75 price for dollar price for carbon emissions in Europe and in the UK. China just started its own carbon emissions trading program. I think the price of carbon on that exchange is somewhere around $7 or $8. So it just got started. Perhaps it will rise over time. But again, the price of carbon is something that consumers and producers alike, I think, are taking into account, will be increasingly taking into account to decide, wow, how much is it worth for me to develop this prospect or use this process that burns fossil fuel. And so that's why we've begun to track this ourselves. Internationally, outside of North America, we want to talk a little bit about where we see things going too. The international market, of course, has a different cyclicality to it than does North America. It's not nearly as volatile, so the cycles aren't as deep typically, nor does it respond as quickly as what we see the case in the US and Canada. And that's kind of what we're seeing this year as well. So activity has begun to recover slowly in aggregate. This is a tracking of Baker Hughes land and offshore rig count outside of North America, and then our projections of it going forward. So we see activity in this international sector rising about 6% next year, from a little over 700 active rigs to about 747, and of course the associated markets with regard to wells drilled, around 7,600, 7,700 new wells drilled, and around 58 million feet of hole drilled next year too. So it looks to us as if in aggregate the international market will be up around 6% next year. One of the interesting things that's emerging in the discussions that you hear people talking about in the past year is what will various discoveries that operators have made become stranded assets if oil and gas consumption falls. So under some of the forecasts that you see that call for oil and gas demand to go down, the question becomes, will some of the reserves that have been discovered ever get produced? And will they instead become stranded assets? And so that's why you see for some countries who are currently exporting oil, that they've now are beginning to talk about accelerating or increasing their production capacity under this use it or lose it sort of mindset that some think is the right way to go about thinking about the business. But there is another set of countries that aren't themselves currently oil exporters, but where oil or gas has been found. And so the challenge in those situations is, what does it take to get these assets up and going before the day comes when the party's over for oil and gas? So some of these LDCs, so less developed countries, have actually begun to think about going out and borrowing the money so that they can take a controlling stake in these discoveries and thus accelerate the development process for the purpose of avoiding, permanently stranding these assets. Again, it all goes back to this forecast or how you feel about whether oil and gas demand will decline and when that decline might begin to take place, and how much time or what you should do about trying to develop assets that you know about right now. So this is a discussion that some countries are beginning to have, and I'm pretty sure we'll hear more about it as time goes by. Before we move off the total international picture, I do want to talk about offshore rigs specifically. So rig activity has fallen there, but is also beginning to recover. And again, we think in terms of rig counts and so forth, we should see activity rise on the order of 8% or so, 8 to 9% year over year in the offshore sector. But one of the things I talk to folks about is the longer term forecast for offshore is, I think, pretty constrained, because historically exploration and appraisal drilling has accounted for roughly half of the rigs running offshore. So that's been a big frontier area that companies have wanted to go explore in the hopes of finding billion-barrel reserves that might cost a lot of money, but probably $5 to $10 per barrel in order to develop. So it's been a big target of opportunity, but in an environment when you're worried about demand for oil and gas flattening out or going down, and B, you've already found a lot of oil and gas, so your booked reserves are pretty substantial and in fact are sufficient to handle demand over the next 20 years under some of these forecasts. It's hard to make the case that it's necessary to go out and conduct exploration, and so a large part of the rigs that we've seen come off in the past year I think are going to stay off, because exploration side of things just it's a harder sell in an environment when there's so much uncertainty and no expectation regarding oil and gas demand growth. So, and that's particularly important to some of the service companies and equipment manufacturers, simply because offshore is such a big part of their served market. On a region basis, story of course will differ. Central and South America has been a fast recovery this year in percentage terms. I think it's leading the way in 2021, and we think that will continue next year as well. 144 active rigs, so activity we think will grow around the 9 to 10% rate in terms of in 2022, and it's occurring in a lot of different places. It's fortunately not just dependent upon one or two countries to carry the region higher. We see Brazil holding fairly steady. Petrobras remains constrained simply because it's so highly levered that it can't really increase activity much beyond where it is today, but it will stay active in terms of developing some of its pre-salt reserves. The story is much the same in Mexico. They don't have pre-salt reserves, but Pemex is highly levered, and so they're doing well just to sort of hold steady with regard to their current level of activity, even as oil prices recover. So those are two big markets in Central and South America, and we think they'll be fairly steady. The bigger sort of success stories, of course, is the highest profile one. The headline one is around Guyana and Suriname, where ExxonMobil and Total Energies and so forth are now well along in terms of exploration and into the development stage as well. Those two countries will host up to 10 rigs next year, so and there's probably growth beyond that point as well. So that's a new market that's opening up and continues to have a lot of possibility, and the operators in question are devoted to continuing work on that. Europe is one that is pretty flat, as you can tell from the chart. Activity has come down and then is just sort of bouncing along, and we don't think there's going to be much to change that. I should make note that for the first time ever, we now include the Ukraine in our European totals. So if you're comparing our European forecast from last quarter to this one, you'll see that it's up about 29 or 30 rigs, and that's all because we're now including Ukraine in the numbers. Our figures for the Ukraine go back to 2019, when Baker Hughes began to count rigs in that country, but it's now a part of this region and will continue to be going forward. So that explains this sort of step change in activity levels. But even with Ukraine in the picture, activity doesn't change very much. We're only looking at about a 1% increase at that. Activity has been supported this year and next year and probably in 2023 as well because in Norway anyway, the government advanced tax credits to operators, but there was a drop-dead deadline, as it were, for the use of those tax credits. They had to commit to beginning to develop properties by a certain date within just a few more months. And so I think it's been pulling forward some activity that might have taken place, development work that might have taken place in 2024, 2025, and it's being pulled into this earlier time frame, and that's helping support activity in the North Sea. UK has its own story. One of the things the UK government has done in support of various climate change initiatives is to say that it wants to institute a climate compatibility checkpoint in any future licensing round. So when it goes off to offer acreage to operators to explore and develop, do their plans meet with the country's goals with regard to reducing carbon emissions? And there have now been other parties that have said, well, if you're going to do this climate compatibility analysis regarding future licensing rounds, you should extend it to any undeveloped leases that are currently out there. So we've seen no development there. Before any development takes place on current leases, they too should be subject to this climate compatibility assessment. And so I think this is going to be a challenge in the UK sector going forward, and may end up continuing to put pressure on operators there and see limited amount of activity over time. Certainly, activity there has fallen just a shadow of what it once was, and we think it'll continue to be the case in the UK. No quick recovery, even if prices were to go much stronger. I think there's these institutional effects that are really constraining activity in that market. Africa is beginning to improve, certainly seen activity on the upswing this year, and we think that overall trend will continue in 2022. Rig forecast for this region is up 7% in 2022. And again, probably the two countries that folks ask us most about are really Nigeria, and that has really, activity there has really suffered for the last several years, in part because there's been sort of an antiquated fiscal and regulatory regime around oil and gas production. Well, there's now a new petroleum industry bill which overhauls those areas. And the question is it too little too late? Because one of the problems with Nigeria is that there's an awful lot of flaring going on, and many of the super majors anyway have said, not only trying to evaluate potential projects in terms of their cost effectiveness and profitability, but also what does it do to our greenhouse gas emission scores, which are increasingly important to management and to investors. So areas that are bad news with regard to things like methane and flaring, and methane emissions flaring and so forth, are beginning to see operators walk away from those, selling their assets to other companies, or just plain shutting things down and walking away. And Nigeria is unfortunately kind of caught into that mindset right now. So even a better fiscal or regulatory regime may not be enough to attract fresh capital back to that sector. Libya has any number of projects regarding restoration of older fields, these brownfield projects, or developing newer fields. And I'm sure we'll hear more about that as the social political situation in that country continues to stabilize. Middle East has finally stopped falling, begun to recover. We think growth of about 6% is in the cards for next year. Iraq is another one of those countries where operations tend to have a high greenhouse gas, high carbon emission standpoint, as it were, and as a result we're seeing various operators looking for ways to exit projects that they have in Iraq. Saudi Arabia is, again, one of the exporting countries I was talking about earlier that is now thinking about more aggressively expanding its oil production capacity. They've been sitting at around 12 million barrels a day of export production capacity for the last several years. Now they're talking about raising that to 12.5 million by 2025, and even 13 million barrels a day at some point, indefinite point beyond that. But again, So that I think is helping. That kind of urgency is beginning to support activity in some of the countries that are oil exporters, where state-owned companies tend to be the primary player. And finally, in Asia Pacific, we're looking at activity rising 5 to 6% again there next year. Much of the activity in this area is function of natural gas development, exploration and development, but natural gas development. So it's interesting to see what's going on there. Indonesia as a country expects to approve 28 plans of development this year. I think it's about halfway to that target right now, and those numbers are up substantially from what they were last year. So we're beginning to see Indonesia, which has been one of the more important countries of this region, begin to see activity step up a little bit there. India continues to advance its offshore gas field development projects. And I think that's important to note that, LNG prices in the last several months have reached, I think, as high as $14 and even $15 per million BTU. Well, India and any other country, but India is certainly a substantial importer of LNG. So it's now seeing its import bills skyrocket, and it only puts more urgency to the development of any of its own indigenous or domestic gas reserves, be they onshore or offshore. Well, a lot of the bigger ones are offshore, and that I think is will add to the drilling and completion work in India over this coming year. And so all that I think is moving in order to support activity in this market, moving gradually higher over time. Finally, we do try and follow activity in China, Russia, and Central Asia. We don't have full rig counts for those markets, but we do estimate how many wells are being drilled, how many feet of hole are being drilled, and so forth, and at least what's being announced in terms of projects by the major players, of course. China is one. It's interesting here in the U.S., while operators here have walked away from a volume mindset and really talked about a profitability mindset, and that's been a big change over the last year or so. In China, they're still holding to the old approach. So the government has recently called on the three big state-owned companies, CNPC, Sinopec, and CNOOC, to increase their spending in order to increase domestic gas production to support their overall economic growth. So government's leaning on these operators to increase activity and lift production, and the issue of profitability is set to one side for now anyway, as these other goals are brought forward. So it's interesting then to hear these companies talk about where they might then find the capability to increase domestic production and shale oil production, something we haven't heard a lot of from China. Most of the shale discussion has been with regard to gas, but shale oil production is apparently an option in some areas, in some of these mature fields. And so we're hearing these operators talk more about discoveries they're making and plans for development that they have on the shale oil side as a way of, again, lifting domestic output. In Russia, hasn't been a lot of news lately in terms of oil and gas development. It's interesting, of course, that Russia continues to be a major gas supplier to both Asia, China, and to Europe. But the government has been focusing recently on ways that it may become a major supplier of hydrogen to both of these markets. So you've got the various colors for hydrogen. Gray hydrogen, which is generally developed from natural gas, but without sequestering the CO2 that's emitted. That's gray hydrogen. Blue hydrogen is when you use gas to generate hydrogen, but you capture the CO2 and you sequester it in some fashion. And then green hydrogen is where you use a renewable like solar or wind to generate hydrogen. You put electrodes in water and generate hydrogen that way, and there's no CO2 emissions to deal with. So I think in Russia we're talking about gray and blue hydrogen projects making use of its extensive natural gas reserves. And it's interesting then the hydrogen would be delivered to market by blending it with natural gas in these pipelines and delivering it to end users. So a lot of technical issues to be solved before all that can happen. But that is something that Russia is looking at and may add to the development of its natural gas reserves. Finally, in Central Asia, we have, again, any number of big projects. All the countries in these areas tend to be exporters of either oil or gas. And the activity there is, as best we can tell, fairly steady over time. And we don't expect much change with regard to that in the coming year. So I think for now that will bring my prepared remarks to an end. And so what I want to do now is bring Richard back in and turn our attention to the questions that have come in that we'd be happy to respond to. So let's do that. I'm going to freeze and then we'll questions.
All right, we're live again. Or we're live. I'm here.
Are we good?
Yeah,
Great.
we are.
Right.
So, John, we got some questions during the process, and I'm going to monitor the chat box here
Sure.
and the emails that we've gotten. And by the way, good job getting it done in an hour. We'll be able to go get brunch here in just a bit.
Sure, yeah.
So one of the questions
Yeah.
was related to the discipline of E&P, because you went into great detail about the discipline of the E&P companies,
Yes.
paying off debt, returning money to shareholders.
Yes.
And the question is an equivalent discipline being demonstrated by the oilfield service companies?
An excellent question, and we do take a look at that. And the short answer is yes. So it's interesting if you look back at 2020 for the year as a whole. We don't track every single oilfield service firm. We've got about 40 public firms that are in that database. And those 40 firms last year collectively retired about $250 million worth of debt.
You said million.
Million, yes.
That's it?
Yes. They were taking on debt. They were net acquirers of debt in the first half of the year. They were paying it off in the second half of last year.
But these are like paltry numbers.
Paltry numbers, yes. So
All
what's
right.
interesting then and more informative is in the first quarter of 2021, those same companies retired like $1.25 billion worth of debt.
Oh,
and the
okay.
number was closer to $1.5 billion worth of debt retirement in the second quarter. So just like the oil companies are now paying down their debt, yes, service firms are doing the same thing.
So one of the things we do to keep track of is those kind of expenditures that would indicate that CapEx is rising for the oilfield service sector. One of the ones I watch all the time is Allison transmission.
Okay.
Because to build a big frack truck, you've got to have a transmission in there. And Allison is one of the suppliers. And they actually have this reporting segment called North American Off-Road. And it's almost entirely the big transmission on frack
So
truck.
one place you can look and get a fairly clean snapshot of what's happening. Yep.
It's one little goose flying north or flying south, but it's been very, very flat. Q2 was up, wasn't up very much.
Okay.
But so Allison sold more transmissions in the second quarter than it had for a year.
Okay.
And so maybe that's just a replacement business, but you're not seeing a CapEx spending pattern by the oilfield service companies.
Well, that's true. So if memory serves me correct, the 40 oilfield service firms I'm talking about, in 2017, 2018, their plowback ratios, it was capital spend divided by cash flow from operations, was about 80%. So, and then it dropped to 60, and last year it was somewhere in the mid-40s, as I recall. And so far this year, it's been closer to a 40% plowback rate. So, kind of makes sense that they're not putting as much money into capital spending and they're returning more money to shareholders. So those two things fit with each other. Right?
People are disciplined.
Yeah. So there will be a few points where some things may begin to tick up a little bit as time goes by, but for now it's been they're certainly following the capital spend discipline.
So we had a question about E&P company investment.
Okay.
And is it 100% oil and gas, or is there some part of new energy in there?
Oh, okay, yeah. Again, when we were looking at those slides that looked at CapEx quarter
Yeah.
by quarter, year by year, that kind of thing. Yeah, so those are just total capital spend dollars. Now, the group of companies that we were talking about are U.S. based and for the most part U.S. focused in their operations. And so those companies as a group have not done a lot in terms of moving to wind and solar.
This is going to be Pioneer,
Yeah.
Conoco,
Yeah, Devon, ConocoPhillips.
but you're also going to have Occidental in there.
Yeah, right, and Hess. And so there's some that are a little bit more diversified, but for the most part, this is not the group that's making a big push into wind and solar. Now, their capital spend dollars would include projects where they're trying to reduce their greenhouse gas emissions. So, for example, Occidental has a big project down in West Texas for carbon capture and sequestration. And so any dollars, for example, being spent on projects like that would be a part of that spend figure that I'm plotting on the chart. But it's not a material amount at this point, I think.
5%?
Maybe among this group of companies, yeah.
Right.
Because again, when you talk about the super majors, the Exxons, the BPs, and the Shells, they're talking about maybe 25% of their capital spend going toward non-fossil fuel stuff. So if they're doing 25%, this group that we're talking about that's so U.S.-centric, yeah, it's going to be more 5%-ish, I think.
I'm going to throw you one more question unless something,
Yeah.
and this is sort of a consolidation of several questions.
Okay.
You've got drilling rigs in the Middle East, and the forecast of drilling in the Middle East, it's not rapidly increasing.
Right.
But I sit on several boards, and what I notice is that the Middle East is a big deal for global sales for any of these service companies
Sure.
that I get to be part of, and it just feels like one active drilling rig in the Middle East is worth way more to me than one active drilling rig in the Permian Basin. And years ago, and like when we first were doing this, 30 and 40 years ago,
Right.
a drilling rig in the United States, Western Oklahoma, West Texas, had a value of like 1 to Baker Hughes,
Mhm.
and a drilling rig somewhere else in the world had a value of like 5 or 10 to Baker Hughes. Do you think that ratio is still the same?
Yeah, so it does make sense, doesn't it? That certain rigs represent more value to a service firm than other rigs. And of course, it's all going to depend upon what's that slate of products that service firm is delivering, right?
Right,
but
because steel tubing, casing and tubing, for
Yeah,
example,
right. Yeah.
5.5, 7-inch, it's kind of be the same whether the well is here or there.
Yeah, so if I look at the international forecast, for example, we talked 750-ish rigs next year, of which the Middle East is going to be roughly a third of that, around 250. So you would say, okay, well, for many service firms, the Middle East is way more than just a third of the international market. It's going to be half. It might be more than half. Again, depending upon what they're providing. But you think about the depth, the size of those wells, and the fact that so many of the certain of the national oil companies, people drilling the wells, are I want your best stuff, so I'm going to pay a premium. That's tended to be the mindset for those kind of wells. So much more so than, say, if you're drilling land wells in South America, for example. So yeah, there's some of these rigs are more equal than others, I guess is the right way to say that.
Well, the Middle East did used to have the reputation for having everything gold plated.
Yes.
But more and more now, because we have a lot of Middle East clients,
Yes.
We see a strong move to make it look more and more like the way operations are done in the United States. A larger oil field with lots of service companies, lots of independent service companies, so that Middle East operators can, in effect, have more competition, drive the price down, but not sacrifice service.
Yeah, the competitive environment's certainly changing there as well, and so that's something to be mindful of anyway. But yeah, you think about land rigs in the Middle East, and of course most offshore rigs around the world. Those are going to be premium type sales opportunities for a lot of the service sector, that's what so many folks we ask us about.
So I think I'm going to draw it to a close right now. I just want to tell our friends and clients here, not that they're different, but we had everybody here in the Tulsa office this week for the first time in a year and a half, and to sort of get ourselves ready for the rest of the year. At the end of this month, we have the Offshore Market report coming out, which is one of the flagship reports. David Ott and Missy Parker are working diligently on that, and so you can expect to see that report hit the streets on schedule, October 1st. But largely when we look around our shop, which is approaching its 60th year of business, business is good. The phone's ringing. Subscription sales, like for the DPO, are back stable again. Things are rising. The consulting related work that we do is keeping us all pretty busy. So, it has a feel around here as that the oil industry is healthy again. And I've always thought that the state of our business was kind of a barometer for how the oil field service and equipment sector was working.
It's certainly a barometer for how our work is.
Well, my wife certainly feels better when we're like that.
Yeah.
Anyway, I thank you very much for participating in the DPO. I'll give it to you, John.
Yeah. Last thing I would say is, who knows what the coming weeks and months will hold. If you ever have any questions about, as things occur, what that might mean to our outlook for activity, please reach out. Either by phone or drop us emails. We're always happy to respond in between these workshops. So feel free to reach out if you need. Otherwise, hope everybody stays well, and we'll see you back again here in December. Thanks.